If Europe's largest pension fund can dump 825 million euros of Palantir, while America's biggest public funds keep holding it and call that duty, you are not looking at a portfolio disagreement. You are looking at a moral split inside Western capital. Most people will hear that and reduce it to politics. I would not. I would reduce it to incentives, power, and the kind of future institutions are willing to finance with other people's retirement money. I have spent enough of my life around capital to know that money always talks long before people admit what it is saying. And right now, money in Europe is saying something very different from money in America. Europe is beginning to say that a profitable company can still become unacceptable if its products deepen a form of state power European institutions no longer want attached to their own names. America, by contrast, is still saying what America usually says when the checks are large enough. If it performs, hold it. If it grows, rationalize it. If somebody complains, hide behind fiduciary duty and call the whole matter complicated. It is not complicated. A Dutch pension giant managing the retirement savings of civil servants did not sell its entire position in Palantir because somebody had a bad quarter. It sold because pressure kept building around one ugly fact. The software was tied in the public mind and in the institution's own ethical framework to surveillance, deportation systems, and military operations that large numbers of its own participants did not want their pensions funding. That is the first thing I want you to understand. This was not a chart decision dressed up in noble language after the fact. It was a values decision that finally forced its way into the balance sheet, and that matters far beyond one stock, because once one institution this large proves that ethics can move real capital, every other institution on that side of the Atlantic has to answer a new question. If they could sell, why are you still holding? That is how precedents spread. Now, before I go any further, I want to make the foundation plain, because people throw the Palantir name around as if everyone should already understand what makes it controversial. What bothered European investors was not simply that Palantir sells software to governments. Plenty of firms do that. What bothered them was the particular kind of power that software represents when it is deployed at scale. Palantir's appeal is that it can pull together huge amounts of disconnected information and make it useful to agencies that want to see patterns before ordinary people even know patterns exist. Communications, travel records, contacts, transactions, biometric identifiers, surveillance feeds, all of it can be fused, filtered, ranked, and turned into action. That is an extraordinary business. It is also exactly the kind of business that forces a society to decide whether efficiency is always progress. When a tool can help authorities track, classify, identify, detain, deport, or target people more effectively, then the question is no longer whether the tool works. The question is whether the institution using it believes there are lines that should not be crossed merely because the machine can cross them faster. That is where the argument started to harden in Europe. The concern centered on two uses that had become impossible to wave away. One was the software's role inside American immigration enforcement. The other was its role in Israeli military operations against Palestinians. Now, I know what some investors will say immediately. A company does not control every decision a government makes after buying software. That is true as far as it goes. But it is also incomplete. If your product becomes a core layer in systems that the world increasingly associates with coercion, then eventually you inherit some of that moral heat whether you like it or not. And European institutions are much more willing than American institutions to admit that. That is why this case matters. A large Dutch pension fund did not stumble into the problem. The position had already existed. It was only when investigative scrutiny brought the holding fully into public view and pension participants started pushing back that the machine began to move. That sequence is important. First, the exposure became visible. Then the participants understood their retirement money was tied to a company whose software sat inside practices their own country officially criticizes. Then the pressure became institutional rather than emotional, and only then did the fund exit. In other words, this was not one dramatic act of conscience in a vacuum. It was the result of friction between what an institution claimed to stand for and what it was actually financing. Those are the moments I watch very closely. In markets, hypocrisy can survive for a long time, but once a large institution is forced to choose between the story it tells and the capital it deploys, you learn which one was real. In this case, the capital moved. The fund confirmed the entire holding was gone. And I want you to notice how fast that became once the contradiction was public. Public revelation to full exit did not take decades. It took months. That speed tells you something. It tells you the ethical case was not weak inside the institution. It had simply not yet become politically unavoidable. Now let me show you why the Atlantic divide is the real story. Because Europe did one thing and America did another. In Europe, the argument was straightforward. Sustainability and responsibility are not decorations. They are part of the investment decision. A fund can weigh return, risk, and social impact at the same time and still call itself a serious steward of capital. In America, the response has been almost the exact opposite. Public pension funds with enormous holdings in the same company have largely refused to divest. The standard explanation is fiduciary duty. We must maximize returns for beneficiaries. We cannot impose politics on the portfolio. Divestment is an extreme last resort. That sounds sober. It also falls apart the minute you compare it with history. American institutions have divested before when politics aligned with doing so. They have taken positions on private prisons. They have taken positions on firearms. They have taken positions on controversial sectors when public pressure was strong enough and when the political cost of holding became larger than the political cost of selling. So let us be adults about this. The phrase fiduciary duty is often used as a principle. Just as often, it is used as cover. The real question is not whether institutions are allowed to incorporate values. They do. The real question is whose values are allowed through the door and whose values are told to wait outside. In Europe, the political and institutional mood increasingly says that human rights concerns belong inside the room. In America, especially in this category of company, the institutional mood says those concerns are an intrusion unless they happen to match a domestic political narrative already in favor. That is not a financial difference. That is a civilizational difference in what capital is expected to do when profit and principle collide. And please do not miss the irony. The United States likes to present itself as the mature market, the pragmatic market, the market that does not indulge in European moral theater. Yet in this case, the supposedly pragmatic position is actually the less honest one, because it pretends that financing certain technologies has no ethical content at all. That is nonsense. Capital allocation always contains ethical content. When you lend, buy, underwrite, or hold, you are helping decide what kind of world gets scaled. You do not escape that by refusing to say it out loud. Now, the defenders of the American position will say something else. Fine, Europe can posture because their sale will not actually damage Palantir. The company is too large. The demand from American investors is too deep. Government contracts are still growing. One European pension fund walking away does not crater the business. That is true in the narrow sense. This single sale does not, but serious investors know reputation. Shocks are rarely dangerous because of one seller. They become dangerous when they create a repeatable template. And that is exactly what this divestment does. It gives every other European fund, university plan, public manager, and regulatory body a clean precedent. If the largest Dutch civil servant fund could conclude that the position no longer fit its framework, others can ask why theirs still does. That is how isolation begins, not with collapse, with legitimacy thinning out one institution at a time. And the European pattern is already larger than this one company. That is the point many Americans still do not want to see. This is not just Palantir. This is part of a broader European reassessment of American exposure across finance, technology, and institutional trust. One pension fund cutting a controversial surveillance company might be dismissed as a single event. It becomes harder to dismiss when you place it alongside other exits, other reductions, and other efforts at strategic distance. European institutions have been reassessing American relationships in clusters. Gold held abroad has become a sovereignty discussion. Dependence on American technology platforms has become a sovereignty discussion. Defense dependence has become a sovereignty discussion. Data dependence has become a sovereignty discussion. Human rights divergence has become a sovereignty discussion. And pension capital, because it sits at the intersection of all these themes, is beginning to reflect that shift. That is why I do not see this as a one-stock controversy. I see it as one more sign that Europe is gradually separating the question of American profitability from the question of American trustworthiness. Those are not the same question anymore. For years, the assumption underneath the Atlantic Alliance was that profit, security, and values broadly traveled together. American institutions made money. European institutions bought in. Everyone called it alignment. That alignment is weakening. Europe is increasingly willing to say, we may still buy your markets, but we will not finance every instrument of your power. That sentence matters, because once institutions start drawing those distinctions, capital no longer behaves like a passive vote of confidence. It becomes a selective vote of approval. And Palantir sits almost perfectly at the center of that shift, because it is not just another software name. It is software embedded in state capacity. It is software embedded in coercive visibility. It is software embedded in the machinery of sorting, identifying, and acting on human beings at scale. That makes it strategically important. It also makes it symbolically radioactive in a way many American investors still underestimate. I want to say something else that may sound uncomfortable, but is worth saying. European investors are not divesting because they are naive about power. They are divesting because they are increasingly afraid of the political and moral price of being seen as passive accomplices to somebody else's version of power. That is a more advanced concern, not a less advanced one. Naivete is pretending a line on a spreadsheet has no biography. Now let us talk about the mechanics, because people love to hide behind abstractions and I prefer mechanisms. How does a move like this happen in practice? It happens when participants inside a fund realize their money is funding something they would object to if you described it to them plainly. Not with euphemisms, plainly. You tell a retired teacher, a nurse, a civil servant, or a municipal worker that part of their pension is tied to software used in deportation systems and military operations that have triggered sustained human rights criticism. You then ask them whether that fits the values their own institution claims to uphold. That is not an abstract ESG conversation anymore. That is personal. And once it becomes personal, pressure develops very quickly. Participants sign petitions. Journalists keep digging. Union voices join in. Other funds are compared. Past divestments are remembered. A board suddenly finds that doing nothing is no longer neutral. Doing nothing becomes a statement. That is when capital starts moving. Notice the asymmetry here. When an institution buys a controversial asset, it usually happens quietly. When it sells one under public pressure, everyone sees it. That visibility gives the sale power beyond its dollar amount. And because this particular fund had already shown a willingness to divest from other companies tied to practices it found unacceptable, the decision in this case did not look random. It looked like pattern. Pattern matters a great deal in institutional behavior. One sale may be noise. A sequence of sales is policy. That is why the Palantir exit should be read, not just as an ethical objection to one company, but as evidence that some European institutions now see ethical inconsistency itself as a portfolio risk. That is a very important evolution. Most investors still think ethics enters the market through soft branding, annual reports, and decorative language at conferences. No ethics enters the market when institutions decide certain returns are not worth the reputational burden, the participant revolt, the regulatory attention, or the contradiction with other positions they already publicly hold. Once that threshold is crossed, ethics becomes capital discipline. Europe is closer to that threshold than America is. That is the message. Now, if you are an American investor, the temptation is to say this is Europe being sanctimonious while America stays practical. But practical about what exactly? About continuing to hold a company because the near-term contracts are strong, about continuing to tell beneficiaries that maximizing return is the only honest definition of duty, about pretending that surveillance technologies linked to coercive state action can be treated like one more neutral growth category that may be practical in the short run. It may also be strategically blind, because if European capital keeps pulling away from categories of American power that clash with European legal and moral frameworks, then American institutions may discover too late that they confuse domestic political permission with international legitimacy. Those are different currencies. And the companies caught in the middle will feel that gap over time. Maybe not this quarter, maybe not next quarter, but legitimacy compounds just like distrust does. I also want you to look at the American side more carefully, because the refusal to divest is itself revealing. It tells you American funds believe the domestic cost of exiting Palantir is currently greater than the domestic cost of staying in. That means political retaliation, ideological labeling, and accusations of abandoning beneficiaries likely loom larger in their minds than reputational damage from the ethical argument. In plain English, the American institutional class has decided that being accused of moralism is more dangerous than being accused of complicity. That is not fiduciary duty. That is political risk management. And once you see it that way, the whole contrast becomes clearer. European funds are managing participant ethics risk. American funds are managing domestic political risk. Both call it stewardship. Only one side is willing to say principle can justify a sale. The other side still needs profit to lose its halo before. Let me tell you what I think happens next. I do not think this single divestment will suddenly cause a rush of American exits. I think the opposite. American public funds will largely hold their positions, issue careful statements, and repeat the language of engagement, monitoring, and long-term obligations. But in Europe, I would expect the opposite drift. More funds will be pushed to review, more participants will ask questions, more unions and public bodies will scrutinize their own exposure. And every time one more institution exits publicly, the burden on the holdouts rises. The real pressure is not on Palantir's revenue line first. The real pressure is on the normality of owning it without explanation. That is where reputational contagion begins. And there is another underappreciated consequence. Once a major pension fund publicly leaves on ethical grounds, regulators and public authorities cannot easily ignore their own relationship with the same company. If a pension fund funded by public workers decides the company is too problematic for retirement money, then why is that company still acceptable inside public policing or administrative systems without deeper scrutiny? That question writes itself, and once it writes itself, bureaucracies are forced to answer it. That is how capital decisions bleed into regulatory decisions, not instantly, gradually, then all at once. I have seen this in many forms. Markets move first at the edges, public language catches up later, formal policy comes last. Investors who wait for the last stage generally pay the highest price for clarity. Now I want to widen the lens one final time. What we are seeing is not Europe becoming anti-American in some theatrical sense. It is Europe becoming more selective about which American systems it wants to remain dependent on and which ones it no longer feels comfortable underwriting, especially when those systems collide with the story Europe tells about law, privacy, rights, and institutional restraint. That selectivity is rational. If your strategic ally keeps drifting in ways that generate moral, political, or legal conflicts for your own institutions, you either absorb the contradiction forever or you begin building distance. Europe is beginning to build distance. Some of that distance is symbolic, some of it is financial, some of it is technological, some of it is ethical. Together they amount to something larger than one divestment. They amount to a slow vote, and slow votes are the ones most investors misread, because nobody rings a bell when trust starts leaving the room. You only notice later when the people who used to fund you automatically now want explanations, carve-outs, and exceptions. That is where I believe we are headed. American institutions are still acting as if Europe's discomfort is mostly noise. Europe is acting as if America's moral confidence is no longer enough collateral. One side thinks the alliance can carry any contradiction. The other side is beginning to mark those contradictions to market. That difference will matter more over the next decade than people think. Let me give you the investor lesson that sits underneath all of this, because otherwise people will hear a political controversy and miss the bigger wealth principle. Capital is never as indifferent as it pretends to be. When the environment is easy, funds can hold contradictory things at the same time. They can market ethics and buy exposure. They can talk sustainability and finance hard power. They can tell participants one story and run the portfolio on another. Bull markets are very forgiving of hypocrisy. Pressure changes that. Pressure forces ranking. Pressure asks what matters more, the extra basis points or the institutional identity. ABP answered that question. Most American funds have not. And this is why I think the story is bigger than Palantir. It tells you how different systems behave once they can no longer postpone the contradiction. One system trims the contradiction and accepts the financial trade-off. The other system trims the rhetoric and keeps the position. That is a profound distinction. It shapes where future capital will go. It shapes which technologies keep their unquestioned access to foreign institutional money. It shapes which governments and public agencies will find their vendor relationships becoming politically expensive. And it shapes how beneficiaries, voters, and regulators start to think about their own role in financing technologies of enforcement and control. Now imagine this pattern repeated over a decade, not once, but across surveillance tools, defense, adjacent software, strategic data infrastructure, cloud dependence, and cross-border public systems. At first it looks like a series of unrelated ethics disputes. Then it becomes a capital map. Then it becomes an alliance map. That is why I keep coming back to the same sentence. This was not a stock sale, it was a signal. The lesson is not that one pension fund sold one controversial stock. The lesson is that capital has started to choose sides in an argument larger than returns. Europe's largest fund did not merely reduce exposure to a software company. It signaled that there are uses of capital it no longer wants to normalize, even when those uses remain profitable and politically protected in the United States. That is a message to other investors. It is a message to regulators. It is a message to American technology firms. And above all, it is a message to anyone still pretending markets are morally neutral. They are not. They never were. The only thing that changes is whether institutions are willing to admit what their money is doing. In this case, one of Europe's largest institutions looked in the mirror and decided it no longer liked the reflection. America looked at the same reflection and said the earnings still look fine. That is the gap. Not a spreadsheet gap, not a multiple gap, a values gap. And when values gaps get large enough, capital gaps usually follow. That is when an isolated exit becomes a trend becomes a re-rating of trust, and a re-rating of trust becomes one of the most expensive things a company or a country can endure. Because once large pools of capital decide your returns are no longer enough to compensate for what you represent, the problem is never only money. The problem is legitimacy. And legitimacy, once it starts trading at a discount, is far harder to buy back than a stock. So if you ask me what Europe's exit from Palantir really means, my answer is simple. It means the era when American institutions could assume that European capital would ignore any contradiction as long as the returns were good enough is beginning to end, slowly, quietly, institution by institution. But that is how all the biggest changes start, not with applause, not with consensus. With one large holder deciding that there are some profits it no longer wants to recognize as clean. And once that decision is made by one serious institution, the rest of the market does not get to pretend the question was never there.